If you're struggling to trade gold consistently, stop looking for another indicator, another strategy, or another secret entry model. Because after spending years watching gold move every single week, I realized that most traders make gold much harder than it actually is. In this video, I'm going to show you the only 3 rules that I personally believe every gold trader should understand. These rules help you simplify your analysis, get a clearer market bias, and avoid getting caught on the wrong side of major moves. And make sure you stay until the end, because I'm going to share a bonus rule that I call the magic rule. It's a simple loophole that makes gold significantly easier to read and can completely change the way you analyze the market. Let's get straight into rule number 3. One of the biggest mistakes traders make when trading gold is spending too much time on lower time frames. They jump between the 1-minute chart, the 5-minute chart, and the 15-minute chart trying to find opportunities, but all they end up finding is noise. The reason higher time frames work so well on gold is because gold is heavily influenced by large institutions, banks, hedge funds, and major market participants. These players are not making decisions based on a 5-minute candle. Their positions are often based on daily, weekly, and even monthly perspectives. Because of that, the higher time frame charts usually provide a much cleaner picture of what the market is actually doing. When you switch to the daily chart, the weekly chart, or even the 4-hour chart, everything starts looking much simpler. The trend becomes easier to identify. Major support and resistance levels become obvious. The market structure becomes cleaner, and most importantly, your bias becomes clearer. For example, if the weekly chart is clearly bullish and the daily chart is also making higher highs and higher lows, then you already know where the probability lies. Instead of fighting the trend, you're trading in the same direction as the larger market participants. This alone can eliminate a huge amount of confusion from your analysis. Before looking for any trade on gold, I always want to know what the higher time frame is doing first. If the higher time frame is bullish, I want to look for buying opportunities. If the higher time frame is bearish, I want to look for selling opportunities. It's simple, clean, and effective. Now let's move to rule number 2. Gold is one of the most news-sensitive markets in the world. A single major headline can completely change the direction of the market. That's why checking the news should be part of your analysis process before you even start looking for trades. Gold reacts strongly to things such as interest rate decisions, CPI data, NFP releases, geopolitical tensions, wars, recession fears, central bank activity, comments from major political leaders, and many other economic events. When uncertainty enters the market, gold can become extremely volatile. Sometimes these moves are so powerful that technical levels get broken within minutes. If you're a newer trader, periods of extreme uncertainty are usually best avoided because volatility becomes unpredictable. However, if you're experienced and understand risk management, these events can create some of the biggest opportunities you'll ever see. The key point here is understanding what type of environment the market is currently in. Is the news supporting gold? Is the news putting pressure on gold? Or is there no major catalyst affecting the market right now? The answers to those questions can completely change your market bias. I've seen traders spend hours drawing support and resistance levels, trend lines, and zones, but they never spend 5 minutes checking the news calendar. Then they get surprised when a major news release sends the market in the opposite direction. Always check the major events scheduled for the week. At the beginning of every month, review the important economic releases. And before taking trades, spend a few minutes understanding what is currently driving the market. When technical analysis and market news are pointing in the same direction, the quality of your setups improves dramatically. Now let's move to the most important rule. If you only remember one thing from this video, remember this. Always check the US dollar index before analyzing gold. The US dollar index, also known as DXY, has one of the strongest relationships with gold. Most of the time, they move in opposite directions. When the dollar becomes stronger, gold often comes under pressure. When the dollar becomes weaker, gold often finds support and starts moving higher. This relationship is one of the biggest advantages a gold trader can use. Imagine you're analyzing gold and everything looks bullish. Your support level is holding. Your market structure is bullish. Your setup looks perfect. But then you open the dollar index and notice that DXY is sitting at a major support level and starting to show signs of strength. That information changes everything. The move that looked easy on gold suddenly becomes much less attractive. Now let's flip the situation. Imagine gold is approaching a key resistance level. At the same time, DXY is approaching a major resistance level and showing signs of weakness. That could be an early clue that gold is preparing for a strong bullish move. This is why I like to analyze DXY before I even begin my gold analysis. The dollar index often provides information that you simply cannot see by looking at gold alone. It helps you understand the bigger picture. It helps you identify potential reversals, and it helps you spot opportunities that many traders completely miss. If you're serious about trading gold, make checking DXY a normal part of your routine. Trust me, once you start doing it consistently, you'll wonder how you ever traded gold without it. Now for the bonus rule. This is something that I genuinely believe makes gold easier to trade. The 4-hour time frame is a sweet spot. It's not too fast and it's not too slow. It removes a lot of the noise that exists on lower time frames while still giving you enough detail to spot opportunities. For some reason, gold often respects structure extremely well on the 4-hour chart. Trends become easier to identify. Support and resistance levels become clearer. Market structure becomes cleaner. Daily bias becomes easier to find. Weekly bias becomes easier to find. And strong directional moves become much easier to anticipate. Many traders try to do everything on lower time frames and end up making their analysis more complicated than necessary. But when you open the 4-hour chart, the market often becomes much easier to understand. That's why I recommend every gold trader spend more time studying the 4-hour chart. You don't need a complicated system. You don't need 10 indicators. You don't need dozens of confirmations. Start with the higher time frame. Understand the news environment. Check the US dollar index. And use the 4-hour chart to simplify your analysis. These are simple rules, but together, they can completely change the way you approach gold trading. If you enjoyed this video, make sure to subscribe to the channel, and I'll see you in the next one.